The market pays attention to China on a day-to-day, week-to-week basis, what China is buying, whether it's not buying, or what its purchase patterns are. Welcome to the Comstock channel. I'm analyst Brian Grete. I want to talk a little bit more on the trade side of things. Obviously, trade has been a major topic in the marketplace, not only in the ag sector, but across the broader marketplace for quite some time now, as President Trump is going forward with his tariff regime, and we've seen deals secured with many of the top trading partners. But what we've also seen is that several of the key trading partners are still out there and negotiating and trying to get the best deal possible and everything. China is right at the top of the list. China is a major U.S. trading partner, especially on the ag side of things, having historically run in the top three in recent years, along with Mexico and Canada for U.S. ag goods. But China's the number one consumer of commodities in the world. Because of that, it carries the most weight, and therefore it gets a lot of attention, and the details and everything that's going to be coming out of the trade talks between the United States and China over the course of the next couple months here as we near that November 10th deadline for the current pause on the tariff programs that are in place for both countries. We'll see how it all shapes out, but I wanted to take a look first at the updated U.S. ag trade outlook from USDA that it released at the end of August last week. As you can see on this chart here, this is the U.S. ag exports in a fiscal year, so dating back to 2019 through the current projection for 2026. The 2025 fiscal year runs through the end of September, so we have another month yet. And then the new 2026 fiscal year begins on October 1st. So this will give you a little bit of a visual. But what we've seen is that the ag imports have been exploding, record levels, expected to back off a little bit as we move forward into the 2026 fiscal year. But the exports, they've also been relatively strong, but as you'll see, they've leveled off the past several years. So while we got the imports rising to record levels, the exports have been leveling off, and what we're seeing is the trade gap has widened. The good news here is USDA's update for fiscal year 2025 isn't as bad as what it was previously in May. The bad news is it's still record large. Now, moving into fiscal year 2026, that trade deficit is expected to narrow, but still be the second highest on record behind wherever 2025 ends up. And so the picture is bleak as we look forward through the ag trade sector, ag trade arena here over the next couple of years. So that means that without the exports, with imports being stronger than the exports, we're going to face more headwinds within the ag sector moving forward. As I mentioned, China is the number one importer of commodities, including the ag commodities, and soybeans are the primary one that we focus on because they are the largest consumer of U.S. soybeans annually. And here you'll see the U.S. ag exports, total ag exports to China in a calendar year. So previously I was talking fiscal years, that runs October through the end of September. This is calendar year, January through December 31st, and comes from USDA GATS. And as you can see, we peaked in 2022 with the record there on ag exports, and we've been in a steady decline since. Now, those two far right bars that you'll see on this chart represent just January through June because that's the latest data we have for calendar year 2025. In an apples to apples comparison, I wanted to show last year, 2024, in that same time period. These numbers will eventually obviously be full year numbers, but the story's the same. You can see a consistent drop off. That 2022 peak, 23 was lower, 24 lower again, and then 25 will be even lower to that degree. And so we've seen quite a bit of a drop off in ag shipments to China, with soybeans being the primary one there. Because China is, like I said, the largest consumer of U.S. soybeans. This is just another look at where U.S. ag products have gone since 2004, so the past 20 years basically. And you'll see that all other countries, aside those that are listed on the chart, is the major buyer. But you'll see China's prominence as one of those top three export destinations. And in fiscal year 2026, and is projected by USDA to fall out of the top three, and not only out of the top three, but out of the top five, and fall into that number 6 category. So that's a significant change from what we've seen over the historical time frame here, represented by the last 20 years. Like I said, China has been a top 3 destination for U.S. ag exports. What's this mean moving forward? Well, any slack that comes from China is going to have to be made up by others. So Mexico and Canada are already the top two ag export destinations. The European Union will have to pick up some of the slack. And then the other category. So all other countries are going to have to take on more imports of not only ag products, but specifically soybeans if we're going to make up the slack for what's projected for China as we move forward. And then this last chart will show you just from a geographical standpoint where the ag exports have gone. And as you can see, Mexico and Canada are the two primaries, and they should be. They're our neighbors, direct neighbors to the south and the north. And so it's easiest and least costly to get those ag exports to those countries. China, obviously overseas there, but prominent in terms of the ag export destination. And then you can see European Union comes in there. Behind that, those three top majors. Like I said, China is projected to fall to number 6 on that list as we move through fiscal year 2026. So what are the implications here? Well, obviously, we need to make up some ground on the soybean side of things, in particular with the ag exports as we move into fiscal year 2026. It's been poor for the past 3 years, and it's going to projected to be even poorer as we move forward through the next fiscal year, October 1 through September of 2026. And so paints a bleak picture moving forward. I think the critical thing is that, it does open up some potential. If President Trump and China can come to an agreement on the trade side of things, there's a lot of room for improvement, major improvement. And we saw that back in the first trade war with China in 2018. The exports were extremely low during that time frame comparatively. As you can see here, there was a major drop off with the first trade war with China in 2018, but we came out of that really aggressively. It took a little bit of time to ramp up. 2019 was stronger, much stronger, but 2020, 2021, 2, and then into 2023, we really saw the ramp up. And so there's potential for something like that to happen again if we get another trade deal. Now, the first one was phase 1. Will this one be deemed phase 2 or some other moniker? Who knows what it ends up being, but the critical thing is that we get China back into the U.S. ag market as a major buyer again, and we haven't seen that. I've talked about it many times here recently, but new crop bookings for U.S. soybeans, corn, sorghum, wheat, cotton, they all sit at 0 at the end of August. And so China hasn't booked anything for the 25 marketing year from the ag arena. They continue to take U.S. pork and U.S. beef, and so that contributes somewhat to their total, obviously, but they just aren't being active within the grains, and it appears that they've pretty much instructed their importers to back away from U.S. ag products, the grains and soy market, until there's some sort of a trade deal. And if that's the case, then we've got ag trade caught up in a pawn, the grain and soy markets caught as pawns within the trading game between Washington and Beijing. Never a good situation to be in, but one that, as this chart will show you, has some real positive outcomes potentially down the road if we can get to a trade deal. Vitally important from now until November 10th that we make some headway on the trade side of things. And if there's another extension, because there's already been 2, if there's another extension onto that where the trade truce is kicked further down the road, then, we have another deadline period that we await. And I think that just the uncertainty and everything else that all this trade drama brings on to the marketplace is somewhat of a wet blanket on prices. From a market perspective, why does China have such a big impact? Well, like I said before, China is the number 1 consumer of commodities around the world, including soybeans and other ag products. And the market pays attention to China on a day-to-day, week-to-week basis, what China is buying, whether it's not buying or what its purchase patterns are. And so it has a bigger price impact than some of the other countries. What we've seen here in the United States recently is that China has been reducing its imports, and so it has a negative price implications there. But what we've also seen is On the soybean side of things, the U.S. crush industry, because of the biofuels demand, has been increasing and ramping up, and it's record large at the moment. The crush number just continuing to get bigger annually and record large there. So that'll lead up some of the slack that's left by China, but it doesn't have the same price impact that the Chinese demand does. The market really pays close attention to Chinese demand, and as a result, that has greater price impact there. So getting China back and ramping up the domestic crush industry would really be a boom for the U.S. soy sector and prices in particular there, because the market does respond to Chinese demand, like I said. If we don't get the Chinese market back, we'll still ship soybeans to other destinations like that chart showed you, and the crush industry will continue to ramp up the crushing pace as we serve the biofuels sector. It just won't have the same impact. If you liked or enjoyed today's content or other content here on the Comstock channel, make sure you like and subscribe to our channel. For the Comstock channel, I'm analyst Brian Grete.
Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.